Welcome back to the Deep Dive. We are jumping straight in today looking at the market data for January 9th, 2026. Our mission is simple. Unpack the key signals in macro, crypto, and even pre-stock so you can see the tension points for yourself.
And that tension is really the whole story right now. You've got high long-term interest rates on one side, and on the other, you have, a clear slowdown in hiring.
Okay, let's start with those rates. The U.S. 10-year Treasury yield is holding high, right around, 4.17 to 4.19%.
Exactly. And so what for you as an investor is that this high rate keeps this constant valuation pressure on, especially for high-growth stocks.
And then you add the jobs data on top of that. December non-farm payrolls, only about 50,000 jobs added. That's a big slowdown.
A huge slowdown. But the unemployment rate actually dropped to 4.4%, which is confusing.
So what does that contradiction mean for the Fed?
It means they'll likely hold steady. I mean, with slowing jobs but sticky inflation, they're in a wait-and-see mode. They can't really rush to ease policy.
And we can't forget about liquidity. We saw high use of the standing repo facility, the SRF, at year-end. That suggests the system is still a bit sensitive.
Yeah, that's right. The SRF is the Fed's emergency backstop. When banks used a lot, it just means private funding is tight. It's a sign of nervousness under the surface.
So that nervousness, how does it translate into capital flows? What's the sentiment?
It's cautious. Very cautious dispersal. We're seeing thin trading volume, and investors are, picking very specific themes while also hedging their bets.
Okay, but the VIX, the fear index, is pretty low. It's around 15.7. Doesn't that suggest complacency?
On the surface, yes. But if you look at the options market, investors are paying a lot for downside protection for puts. So the fear isn't gone, it's just being priced into hedges.
And that anxiety carries right over into digital assets, I assume.
It does. The crypto fear and greed index is sitting in the cautious or fear zone, somewhere between 30 and 45. It's better than the extreme fear from year-end, but still nervous.
And Bitcoin itself is just consolidating. It's stuck at that key $90,000 to $91,000 resistance level.
Right. And the deciding factor there isn't just macro anymore. It's all about institutional flows. We have to watch the ETF and options data. That's what will decide the next move.
So let's look at some specific assets. The big ETFs, VOO and QQQM, they're basically flat, just consolidating.
They are, because they're being pulled in two directions. You have the rate pressure pulling them down, but then you have a few mega caps holding everything up.
And NVIDIA is leading that charge, right? Trading around 185 to 189. The AI demand is just not slowing down.
It's not. The spending on AI infrastructure is, for now, seen as inelastic. The big cloud providers are still pouring capital into GPUs.
Meanwhile, the classic hedge trade is working. Golds and silver are holding up really well.
Yep. Gold is around $44.69 an ounce. Silver's at $76 to $80. That's textbook safe haven buying because of geopolitical risk.
Okay, let's go to the other extreme. Pre-stocks. We're seeing some wild pricing. Anthropic around $315 to $325. OpenAI has a huge spread, like $1,020 to $1,100.
And that just screams illiquidity. This is a market for, very small, very speculative allocations. The risk that you can't sell when you want to is enormous.
So after all this, what's the strategy? How should you be positioned?
It really boils down to a defense-first approach. You use your core ETFs like VOO for stability, maybe add some AI leaders like NVIDIA in stages.
But with strict rules.
With very strict stop-loss rules, especially for anything volatile like crypto. The direction from here is going to be driven by the next batch of macro data.
So we wait for ISM numbers, for any new Fed commentary.
Yes, but here's the final thought for you. Go beyond the headlines. Actually track the institutional funding flows. Watch the net inflows to the Bitcoin ETFs and the open interest on the futures. That's the real signal. Where the money is physically moving, that tells you more than any report.